Gold had its worst quarter on record. It's down 14% this quarter, sitting nearly $4,050 an ounce. And that's after touching an all time high of around $5,600 just back in January. So is the gold story over? No. Something bigger is building underneath this dip. July 4th, when US has its 250th Independence Day, could make a move that resets how the world thinks about gold for the next 50 years. Let me walk you through it. Step back 2 years, gold was trading around $1,900 a troy ounce, which is about 31 grams. But from there, it ran away all the way till $5,600 until this correction. And the biggest reason behind that move, it's not jewelry demand, it's not retail investor, it's actually central banks. Around the world, central banks have been cutting back on US dollar treasuries and replacing them with gold. Let me talk about some numbers. Central banks bought more than 1,000 tons of gold each year from 2022 till 2024. And last year, they bought another 853 tons. And this year, again, they are back buying hard. In the first quarter of 26 alone, central banks bought more than 244 tons of gold. And that's more than double the pace of the previous decade. Here's the headline number. For the first time since 96, foreign central banks now hold more gold than US Treasuries in the reserves. And gold has overtaken US government debt as a reserve asset. The dollar is still dominant, but its share of global reserves has been sliding for years, from around 71% at the start of the century to under 57% today, as per the IMF's latest numbers. And gold's been filling that gap. European Central Bank actually confirmed this directly last month that gold makes up 27% of global central bank reserves, up from 20% a year ago. Treasuries, meanwhile, slipped to 22%. And the central banks aren't done yet. In the World Gold Council newest survey out this June, 89% reserve managers expect that global gold reserves to keep rising over the next year. A record 45% say they plan to add to their own reserves, the highest in survey's 8 year history. And 74% expect the dollar share to keep falling over the next 5 years. So the chart looks ugly right now. But the people who matter most, the central banks, they are still buying the story. Now flip it around. Think about this from America's side. US is running a national debt of more than $38 trillion. Its annual interest payments alone have crossed $1 trillion. If the rest of the world keep moving out of dollar treasuries and into gold, then demand for US debt will soften, borrowing cost will stay high. If the rest of the world keeps moving out of dollar treasuries and into gold, demand for US debt will soften, borrowing cost will stay high, and US could get squeezed from both the sides, bigger interest payments and bigger deficits at the same time. Now that's a slow moving problem, but a serious one. And so US needs a response, and this is where it gets really interesting. Judy Shelton, an economist, a former Federal Reserve nominee, has proposed something genuinely creative. She calls it stopping the dollar debasement trade. Her idea? Issue a new kind of US government bond, time around July 4th, 2026, America's 250th anniversary, and she calls them Treasury Trust bonds. Here is how they would work. A 50-year bond maturing on 4th of July 2076, country's 300th anniversary, and when it matures, the investor gets a choice: take it in dollars or take a fixed amount of physical gold instead. The investor decides, something very similar to SGBs that we have in India. Think of it like an inflation protected bond, except this one is debasement protected. And if you don't trust where the dollar will be in 50 years, you take the gold. If you take the cash, this does three things at once. First, it rebuilds confidence in US treasuries because now they carry a gold backstop. Second, it forces an honest reevaluation of America's gold. The US holds close to 261 million ounces in Fort Knox, but on the books, that gold is still valued at just $42 an ounce, a price which was set back way back in 1973. At today's market price of around $4,000, revaluing it would create a paper gain of close to $1 trillion almost overnight without buying a single extra ounce. Third, and this is the big one, it puts the gold right back at the center of monetary system. If the most powerful country on earth starts treating its gold as collateral for its debt, every other central bank takes notice. Now, this is a proposal. It's not a done deal yet. It may not even be announced on 4th of July. And even if it is, a bond like this raises some real questions. At what price is gold convertible? Does it tie the government's hands? Will investor actually want it? Nobody knows yet. And remember, gold just fell almost 28% from its January peak. The trigger was market pricing in more US interest rate hikes on sticky inflation and tensions in the Middle East. When rates are expected to rise, gold usually struggles in the short term. So, this is a two-way market. So, where do we land? At CrispIdea, we remain structurally positive on gold. The central bank buying is real, the de dollarization trend is real, the policy momentum in US is real. For Indian investors, there is a second angle. A softer rupee tends to lift gold prices in rupee terms even further. Over a 10-year horizon, our view is that gold in rupee terms could move up meaningfully from here. But here is what to actually watch. Keep an eye on July 4th. If the US really does announce a gold linked treasury bond, expect a sharp move up in gold, not just over the coming months, but potentially over the coming years as well. If you found this useful, keep following Crisp Idea for more. Thanks for watching.